So good afternoon, everybody. My name is Rich Harvey, CEO at Propertybuyer. Thank you so much for joining us today on our webinar about how to build wealth, retire sooner, and talk about some tax-effective property strategies. Very delighted to have John Kalachian with me today. Welcome, John.
Thanks, Rich.
Great to have you as well. And John and I met each other maybe 15, 20 years ago, I think it was, when we actually did a webinar way back then. So we've just
It
reconnected.
wasn't even a webinar back then, Rich. I think it was a
A
seminar.
seminar, sorry, it's a seminar. Get with the digital program. Okay, here we go. It was a
Zoom wasn't
seminar back
around
then.
back then, I think.
Yeah. So, John, just by way of introduction, how long have you been an accountant for?
Oh, Rich, too long. I suppose maybe that's the answer. A lot of people say. Now, I've been doing this for around about, I've been doing this for more than 20 years. 25 is actually pretty close. I've had my own business for around about 20 years of that. So, yeah, a lot of experience in the area, a lot of
Right.
stuff is for businesses and a lot of stuff for property guys as well.
Wonderful. Well, look, without further ado, can I please hand over to you? Just the way we'll run this today. John, if you'd like to start sharing your screen,
Yeah,
just while I do
sure.
the intros for everybody. We'll go through John's presentation, which will be about 20, 25 minutes around tax effective strategies, mistakes to look out for. Then I'll present some actual strategies and some case studies. And then if you've got Q&A, please just use the box called Q&A at the bottom of the screen. Love to answer all your questions. We'll have 15 to 20 minutes at the end of the presentations to go through all your questions. Like to get through them, so don't delay writing your questions in there. And we'll look forward to presenting those toward the end. So, John, over to you. Thank you.
Thank you. Firstly, Rich, once again, a big thank you for inviting me to present with you today. As Rich said earlier, I've known Rich for 15, 20 years. We did a seminar together many, many years ago, and we sort of bumped into each other not long ago, and we sort of said, let's do another one. And obviously, Rich is very experienced in his field, and he's invited me along to talk about a bit of tax stuff. So firstly, I just want to double check, Rich, can you see my screen? Is everything
Absolutely.
okay
All
there?
good, mate. 100%. All good.
Perfect, perfect. So what we're going to talk about today is my take on this is about the tax side of it and some mistakes and stuff I've seen, and also some strategies that we sort of do for some clients. But a bit about Fortis Accounting Partners first. But we're an accounting firm, so that means we do all sorts of compliance, all sorts of tax returns, which is very typical. Everyone has to do a tax return, whether or not you're in business or an individual taxpayer or even a property owner. Everyone has to do tax returns. We do those with lodge returns, with ATO. We take care of other government departments such as OSR, ASIC, fair trading. So the taxpayer remains completely compliant. However, most accounts pretty much stop there. What we also do, which is probably more than 50% of our business now, is we do tax advisory, or people call it tax advice. Is when we have to make decisions now that will minimize the tax for the client, that the client pays now or also in the future. That's what we have to do. And so it's a nice picture of me there, and it's shot a couple of years ago. It's future planning or tax advisory is when a client says to me, John, I'm thinking about starting a business. I'm thinking about buying a property. I'm thinking about selling something. I'm thinking about my super. I'm thinking about self-managed super funds. All these things, we put things in place now to go ahead and reduce the taxes now and also in the future, which is tax advisory. Tax returns are quite historical. This is about future planning. This is what we sort of do when it comes to tax advisory. Now, our main clients, we deal with small to medium-sized businesses and a lot of property investors. We've got a very big portfolio of property investor clients as well. So why property? Look, firstly, in my own case, I have a very big personal interest in property, and a lot of my clients do too. So we do a lot of it in our office. We have clients with one or two investment properties. We have clients with dozens of investment properties, all in different structures as well. I suppose for myself, I didn't realize this was happening, but when I was a kid, my dad used to make me read the real estate section for him in the paper every Sunday. Um, I thought I was in trouble probably at the time, but looking back, and I think he was trying to teach me something. He was teaching me about yields. He's teaching me about what you could buy, how much you could borrow from the bank, et cetera, which is
He's a
quite
good dad then by doing that for you, I tell you.
Sorry, what was that?
He's a good dad getting you in early.
I didn't realize what he was doing. All right, so it's interesting, but yeah, so that's the reason I've developed a bit of a property portfolio myself, and at the same time, we do a lot for these kind of clients as well. So. Oh, there we go. What we're talking about today, so we're going to talk about some mistakes that property investors make. We're going to talk a little bit about capital gains tax and land tax to put a bit of clarification on that. We're going to talk about structuring or what name you should buy a property in. And we're going to look at some examples, some effective property investing. Okay, so let's start with the first one. Okay, so 5 classic mistakes that we make as property investors. Before we get there, I just want to jump onto why it's such an important thing. Okay, so when we book the wrong flight, or when we buy a bit of software, or buy the wrong lunch, it costs us a few $100, costs us $10 to buy a new lunch, right? But when you make a mistake with property, it costs you thousands upon thousands of dollars. You could have a property sitting there empty for many months if you bought in the wrong area. You could not get the right tenants. You could be in an area where you don't get much capital growth. And even if you do, if you haven't got the right advice, you can probably pay more tax than you need to. And that's where we come into it. And that's why it's so important to make sure we get the right people around us and make sure we don't make mistakes when it comes to property as well. First mistake we always see. Before we start the property journey, it's really important to get the right people around us. Okay, there's 4 people we need in property. Okay, one is a buyer's agent, one is an accountant, one is a lawyer, and one is a loan broker. Okay, if there's anything today that you need to go ahead and do, is you make sure you need to get the right people around you. Now, we've got an amazing buyer's agent on the line today. Rich has been doing this for many, many years, very, very experienced. And what he does is he's going to do the research that you cannot do. He's going to look at properties that you didn't even think of. Okay, and that's what a buyer's agent does. He negotiates for you. He finds the right property. A lawyer is really good at the very beginning when they do the contract. I've had examples where lawyers have made a deal work, and I work with some amazing lawyers, and I'll probably work with some lawyers I probably wouldn't recommend either. And the way I sort of break that down is experience. You want to work with a lawyer that's done this heaps and heaps of times and able to navigate the process through and not cause any issues. Got a loan broker there. Loan brokers are really, really important. Loan brokers are really important. They are the financing people, right? They are the ones who are going to make sure that you can get the loan. And having the right financing guy, loan broker in front of us, is the guy that's going to make sure that we can get the loan at that point in time. If we make a mistake at the very beginning and have a credit card default, have a HEX debt, or have something like that, they will teach us what we need to do for a period of time to make sure the banks don't look at any issues that we had previously. And an accountant. Obviously, an accountant's the person that you're going to talk about with structure. Okay, they're the person that's going to run the numbers and make sure that it makes sense to you. In the property game, you need an accountant. Okay, now what I mean by that, if you've got accountant is someone who's going to return your phone call, he's going to return your emails, he's going to be on speed dial for you. If you haven't got that in your accountant, you haven't got an accountant, you've got a tax preparer. You've got a person that fills in a form for you once a year called a tax return. What you need is someone on speed dial to be able to ask them the questions and to get the right results. That's the first thing. Get the right team of people in front of you. Okay. Next one, not having a strategy and not having a long-term strategy. Okay. When we talk to clients, first thing we talk about, if we don't talk about a single property, we talk about multiple properties. We talk about having the ability to buy one now, but then having a plan that in 2 years' time, we can buy another one. And in 2 years' time, we plan to have kids. So we want to buy that property before my wife goes on maternity leave, for example, and therefore I can get the loan. All right. We want to talk about then we're going to wait another couple of years after that, and we want to build up enough equity in property 1 to release some equity and buy property number 3. Then by that stage, we may be able to be in a position where we've got enough super to buy property in a self-managed super fund. Now, that's a strategy. The strategies change, but it's better to have a strategy than not have a strategy. If I say to myself, one day I'm going to go buy one property, then I will only ever buy one property. But if I say I'm going to buy 5 properties in the next 10 years, I will make sure I have a goal to do that. And that might change, but at least it's there in front of me and I'll go ahead and do it. The next thing we see a lot of mistakes in not enough research. Now, if you're going to do this yourself, you need to research every weekend. You need to go to 30 or 40 open homes in certain areas. You need to do internet searches. You need to look at past sales results. You need to look at present sale results. This takes time. It's time well spent. If you haven't got the time, you call Rich straight away. He's going to do it for you. He does it every single day. You need to look at things like prices, locations, yield, schools, transport, infrastructure, all that stuff. We're not the typical 20, 30 years ago, you bought the house next door. Okay, not anymore. The world's become smaller. Australia's become more available to go and buy property in, and that's where someone like Rich can come into it. Okay, so do your research. Next one, know your numbers. Okay, this starts with finance. How much can I borrow? This will give us our parameters of property purchase. There's no point in looking at a $1.5 million property if the bank's only going to lend us up to $1 million. We're wasting our time. Okay, so it's really good to get your finance sorted out first, know your numbers, but then we've got to then work out if the bank's going to give me $1 million, for example, then can I afford it based on the property numbers? We run spreadsheets. We have a look at rental scenarios, see how much we're going to be left with after all the expenses, and then say, well, you need to chip in this much every month or every week. And can I then afford that? If you can, we do it. If you can't, we don't want to make the mistake of then buying something we can't afford and having to sell it in a couple of years' time as well. Okay. The last one of the big mistakes we do see, and the question I get the most of, is investing in the wrong structure. This is, whose name should I buy it in? Should I buy it in mine? Should I buy it in my spouse's name? Should I buy it jointly? Should I buy it in a trust, self-managed super fund, a company? This will not make a difference in the property itself. It doesn't matter whose name it is. The property will receive the same rent. It will receive the same capital growth in the same area. It will not make a difference for you when it comes to the growth or rental return of the property, but it will make a difference in how you can access the money. It will make a difference in how much tax you pay now and also capital gains tax in the future as well. Okay, so these are the mistakes that we do see regularly, and we recommend the first one is probably the most important. Get the right team of professionals around you, then the rest of it flows through. Okay, I'm going to talk quickly about capital gains tax and land tax. The reason is because there's a bit of clarification here. So what is capital gains tax? Tax we have to pay on the sale of an asset. Capital gains tax rules are different to income tax rules. It's a separate part of the legislation, right? And effectively, I just want to share this, but a lot of people know this already, but it's a good refresher. If you hold an asset for longer than 12 months, the capital gains tax halves. Why is this important, right? Because to put in context, if I make 100 grand from working or 100 grand from a capital gain, I'm going to be left with more in my pocket with a capital gain than I am with working. So it's just as important to think about. Some people say to me, John, I can just earn 100 grand more at work, even my business. Why should I invest? Well, actually, no. It's actually better off for tax purposes as well. It's a good thing to sort of think about when we do our calculations for taxes going forward. Okay. Then we've got land tax. Now, land tax is an interesting one. Land tax is an annual tax based on the total taxable value of the land we own. Great. It is managed by each state separately. The rates and the thresholds are different for each state. So you've got to know all this stuff, right? I put something at the bottom there that it's not exactly true, but I've written land tax is not compulsory, right? But let me just rephrase that a little bit. Land tax is compulsory if you're above the thresholds. But I have clients with 2 properties and they're paying land tax. I have clients with 6, 7, 8 properties and they're not paying any land tax. Okay, so we can plan this out to make sure that what we do, what we buy, whose names are under, we're going to avoid some of these important taxes that could be quite substantial when it comes to our decision making going forward and how much we're left with at the end of the day. This is a good segue into whose name should I hold the property in, or structure. Okay, so it's interesting. Most accountants will talk about the most common structure. I'll get this question all the time. What is the best structure I should invest in? Now, no one's going to like this answer, but it depends. Okay, it depends on the client situation, as every client is unique. Most accountants will look at this. We'll look at income tax and capital gains tax. And I say, oh, it's better for income tax under your name. It's better for capital gains under such and such's name, and therefore we'll buy it under that name. What we look at is all of the above. We look at stamp duty. We look at a land tax. We look at how much you're earning now and also in the future. We look at how much loans you have. We look at how many properties you have. Are you married? Do you have kids? Does your spouse own property as well? How long do you want to hold the property for? Is it positively geared? Is it negatively geared? How much super I have? These will all make a difference to how we go ahead and make the decision of what name we should put the property in. It's very, very important because it makes a big difference. I'm going to show you some examples now. Okay. Once again, let me show you why. Okay. And this is a little table I've sort of drafted a little bit. Okay. It shows the main entities that we can go ahead and invest in Australia. Right? We've got individuals, we've got companies, we've got trusts and super funds. Individuals, if you buy it in more than one name, it becomes a partnership. So 2 individuals. You can buy a trust. There's a couple of different versions of trust as well. And each of them have their pros and their cons. Okay. There's no one size fits all. If you're going to buy a property, if you're going to live in, ideally under the main residence exemption, it's better to put under your name. Right. But if you're going to buy a property that you might hold for a long period of time, a super fund is amazing. The lowest form of tax. It's fantastic. But a super fund does not let you have equity in that, so you can then buy property out of your own name in the future. Each of them horses for courses. Trusts are really flexible, but not good for land tax until it's your third property, third or fourth property. It sort of works that way. So everyone is unique in what they do, and everyone's situation is unique, and the property is unique, and therefore we have to go through that previous slide with the different levels to work out if we're going to do an individual, company, trust, or a self-managed super fund for our clients. I'm going to run through some examples now. A quick one. It's probably not even a property example, but just something I want to share with you. So obviously when we buy property and buy our own main residence, we take loans out for it. Now there's 2 types of loans. I say good debt and bad debt. Probably no such thing as good debt. We saw bad debt and worse debt, right? So bad debt is effectively just debt we have, investment property or whatever, but the worst debt is a loan or interest we can't claim. So if we buy a property under our own name, our main residence, then we can't claim the loan. We had a client, for example, had a $2 million loan on his $3 million main residence. He also had a share portfolio of about $800,000 over the time. A really simple scenario. He said, John, I want to go ahead and reduce my non-deductible home loan, right? Because it's a pretty bad debt to go ahead and do it. So we did, very simple scenario. We went ahead and did some advice for him, and we sold the $800,000 in shares he had. He had a little bit of capital gain there to sort of deal with, but we do the numbers for him, and then he can make his mind up. And looking at that, what we actually did was sold the $800,000 shares, put the money into his non-deductible home loan, spoke to a loan broker, redrew up that money, and therefore that amount in the home loan now is tax deductible. So we've moved the home loan or a portion of the home loan against the shares. We bought the shares the next day. So we sold shares, put in a home loan, drew it back up, bought the shares the next day, got no difference in the actual value of it, which was quite good, right? Paid a little bit of capital gains, but just in that scenario alone, we've moved $700,000 odd to amount now being deductible, which saves us about $48,000 of interest every single year, which saves us 22 grand in tax for not doing much, being a bit smart, okay? And we always work out a bit of a break-even point for the client as well. If you plan to hold the property for less than 3 years in this scenario, it doesn't work. If you plan to hold the property over a 10-year period, this is going to be hundreds of thousands of dollars better off. Okay, that's what we do. And we get another example. This is a real simple one that I sort of talk to clients about, land tax. Land tax is the kind of thing which has crept up upon clients over the last 10 years. And the reason being is that the land values have gone up by so much and the thresholds haven't followed by as much, I suppose. Okay. So generally what people used to do in the old day was buy properties in joint names, myself and my spouse, for example. And in this scenario, very simple example, the client has 2 properties excluding their main residence, and their property one's worth $800,000, property 2 is worth $700,000. They've bought it in joint names. Total is 1.5. The land tax threshold is just over $1 million in New South Wales this year. The land tax is $6,800 they have to pay every single year, and that'll keep going up based on the value of the property as well. But if we're a bit smart about it, instead of buying them both in joint names, we bought them one whole one in spouse 1 and the other one in spouse 2. We have the same amount of property, we have the same amount of loans. The value is 1.5 again, but each of the participants or each of the spouses now, each of the taxpayers receive their own tax-free threshold, and therefore they're both under the $1 million, and therefore land tax is nil. Once again, not doing too much here, but we're able to save the client this ongoing $6,500, $7,000 amount to pay every single year, which could make the difference between us being able to afford it or not. And that's really, really important. I'll give a last example of a client that we did some stuff for from SMSF. So self-managed super fund has become something quite substantial over the last probably 10 or so years. The rules changed in 2007, but no one really did much for the first probably 3 or 4 years. So I was still trying to work out the legislation. But what we've done a lot of these kind of stuff. And I did an example for a client of if they bought a property under their own name versus under a self-managed super fund. So I'm not going to run through all the numbers, but a typical property was $500,000. This was in Perth. We got a rental yield. I've assumed a capital growth of 7%, which is a lot of people say to me, John, it's quite conservative. Probably should go a bit higher than that. And a rental growth of 2.5% to follow a bit of CPI, and the interest rate about 6.5%. Now, on those numbers, that's the actual property they went ahead and bought. I've run some spreadsheets on some loan numbers to show it's going to get paid off in about 15 years' time. I'll do some tax numbers for an individual up here and a super fund down there. We summarize and look at capital gains tax and what that's going to look like. And what you'll see now is that in the old scheme of things, when it comes to capital gains, where super's quite good, super becomes tax-free when we retire. It's very, very advantageous compared to us paying capital gains tax individually or through a trust or through a company, for example. You've got to pay tax on that, but under a super fund, it's tax-free. So the difference is quite substantial. $324,000 just in this one property over a 15-year period. Once again, the property is the same. The rental's the same. The growth is the same. Whether it's under my name or under a trust or a super fund, it's what the tax numbers show us. Now, that's pretty exciting for me, right? When I can save a client that kind of money, I get pretty excited. Now, Rich, before, I'm not sure if you mentioned it, we were talking earlier before the chat. I'm a bit of a fisherman, so I love going fishing. I love my sport, family, fishing, you name it. And I was fishing the other day, a little while ago, actually a couple of months ago, and on the water, and I saw this thing. Okay, now that was amazing. We were actually pretty close to it, and it breached in front of us. So it was pretty cool to see. So we kept on going. We fish about 30 odd Ks outside the heads, and we try to get something, put a bit of bait in the water and see what we can get. And after a 45-minute fight, I've got one of these things.
What did you buy? Is that tuna? Yellowfin?
A yellowfin tuna, 32
wow.
kilos. It's pretty heavy. It was a really good catch. 45 minutes of fighting to get it up. It was amazing. But I'll tell you that was an amazing experience to do that. But I'll tell you what was even more amazing, Rich, saving $324,000 for a client. Okay. So I'll sort of finish it off there, but just wanted to sort of tell you a bit about us. So Fortis Accounting Partners, if anyone's got any questions in regard to their taxes or what we should do when it comes to property or different structures, there's our details there, but Rich has them anyway and probably share them after the seminar.
Fantastic, John.
Thank you.
Oh, it's so good. Look, thank you so much. That's wonderful. I'll just get you to stop sharing and then I'll share my screen now, John.
Perfect. Thank you, Rich.
No, that's great. Look, really, really good intel. It's funny. I'll just make one quick point, if I may, just about your idea of buying in the right name. We'll get to this with the questions, but I'm helping a lot of people move through that accumulation phase to what I call the rebalancing phase of their portfolio growth. So you'd say you're in your 20s and 30s and 40s. That should be the time you're buying multiple properties, and you might buy some in your own name, you might buy some in a trust name, etc., and some in your super fund. But then when you get to sort of your late 50s or 60s, you might actually end up selling a bunch of properties and then transferring and then buying more commercial properties or high yield properties, putting them into your self-managed super fund because you want to go for yield and some growth. And it just doesn't mean that you hold the property for 80 years, right? There is a rebalancing strategy, and that's exactly what I'm doing myself right now with my substantial portfolio.
Absolutely. We say it a lot with clients because it also comes down to the rental yield they're earning or where it's located, and situations do change. So absolutely, property is like a share portfolio. You have to muck around with it a little bit to get the right result. So
that's it.
Yeah, absolutely agree.
So, John, thank you for sharing that. I'm going to duck through some slides now, and just get into it straight away. I won't go through all my background. I should be sharing all the slides later on, but just have to say that I've been in the game for 25 years this year. Love what I do. I could retire tomorrow, but I don't want to because I love helping people get the right property and build their portfolios. So, I wanted today to talk about reverse engineering your retirement. I want to talk about some strategies, get into some case studies, and then open it up for Q&A. So I can't see people's faces, but I hope you got a cup of tea, coffee, whatever. You're getting a bit of lunchtime, a bit of vibe here, get it going. So a question I get asked all the time, John, is how many properties do I need to retire? Now, that's a particular question I get asked. A better question to ask is what value of my portfolio do I need to retire? It's not so much the number of properties, but it's the actual overall value, right? So I want to get into this in a bit more detail. Now I'm going to have to just unshare my screen for a second and then reshare. I've got an actual calculator, right? That we've got here. So I'm just going to pull up and I hope this works. I'm going to do a live demonstration. This is a bit technical. Let's see how we go. All right. Give me a thumbs up, John. You can see the spreadsheet. Yep, cool, great. Okay, so I've been working on this for a while. We've created this little model, it takes about 10 seconds to calculate. There's a lot of CAGR, capital annual growth calculations in this. There's a lot of assumptions. So what we've got here is very first cell, you put in your desired retirement income. So let's say it's $100,000. Now I've put a nominal property price here of 700,000. Okay. Your deposit requires 20%, 140 grand. We're now in 2025. We're assuming around a 5% rental yield. Okay. Just a basic assumption. So you need 560 grand. We're looking at current bank lending rates. This is before the reductions, by the way, 6.1%. We're looking at long-term bank rates, like when the interest rate cuts come through, down to around 5%. We're assuming a 3% capital rental increase per annum on inflation, 7% capital growth, and inflation also at 3%. So what this calculator tells me that I need 6 properties over the next 16 years, and I could potentially retire in 2041. Okay, so again, you're buying a property here in 2025, 3 years later, you're buying another one, 3 years later, you're buying another one, etc. So some people might go, oh, Rich, that's not that great. I want to retire faster. Okay, so let's have a slightly higher income number that we want to get. We want $200,000 in rental income, okay, in retirement income, passive income. And I'm also, sorry, it takes a few seconds to recalculate. It takes about 8 seconds to do the numbers here. So again, if I want $200,000 in retirement income at a 700,000 average purchase price, it's going to take me a bit longer to retire. But if I can accelerate that by buying more expensive properties, let's say I buy $1 million properties, let's see how long it takes to retire down here. So it's just calculating, and let's see what the magic number is. So it says I need 7 properties over 17 years to get to that 200 grand. Okay. So the interesting thing is this, by the way, John and everyone watching, this assumes a lot of assumptions. Okay. There are a lot of simplistic assumptions. It's going to depend on your income. It's going to depend on how fast so you might be able to buy 3 properties in year 1 and then another property 3 or 4 years later. So you also might buy more expensive properties along the way to accelerate your wealth. But the goal is here to say you need to buy multiple properties to achieve that goal. Now, I'm happy to share this spreadsheet with everybody today that's on the call or who's registered. So if we can play around with this spreadsheet as long as you like. We've got all the charts here that shows you how it maps it all out, your net income over time. I'll just slide across here. And then here's all the numbers here. So it's basically showing that you're going to achieve by the year 2042, okay, you've got your 7 properties, but your net income here, 208,000 in year 2042, okay? So that's achieving all the right numbers you want to hit. Again, lots of assumptions there and depreciation, all bits and pieces, but again, this is just a guidebook to show you how to think about buying multiple properties to achieve that end goal. All right, how do I stop share? I'm going to click off that. So the next question becomes, I'm going to share my screen again with a different spreadsheet. Where is it here? Hang on a sec. I've got to work out which one it is, not the retirement calculator. Oh gosh. Hang on, I've got to go back 1 second now. Give me 1 sec. I've got to work out which spreadsheet I'm showing. Not that one. It's the other one. It's just having a little think. Give
That
me.
was really good, Rich. I think that the important part there is that, once again, if we're going to do the property journey, I think
Mm.
that it shouldn't be just one property. We
Yeah,
have
correct.
to buy multiple property. Unless we buy one property, it's going to give us 200 grand worth of revenue, for example, which is
That's right.
very, very difficult to happen. I wouldn't recommend it to clients as well, because you don't want all your eggs in one basket either, right?
Correct.
So it's part
Mm.
of the journey, part of the long-term plan, which is what we chatted about before.
Cool. John, give me a thumbs up. You can see this
Yeah,
portfolio tracker. Great, perfect.
fantastic.
So again, this has got 5 tabs on this spreadsheet. Again, we'll give this away for free. We've taken quite a lot of time to develop this, but this is the spreadsheet I use myself for tracking my own portfolio. This is not my portfolio on this spreadsheet, by the way. It's just a blank sheet that you can fill in. So you've got a description of how to use it. Then we've got assets and liabilities. So you click on this and you put in here all your numbers, basically. Let's get that out of the way. So you put in your properties that you buy. You put in what structure you own them, whether it's in your personal name or a company or a trust, the lender, your acquisition date, the value. And basically, this is a great spreadsheet. You'll love this, don't you, John? If all your clients did this, right, you give them a gold star, wouldn't you? Right? So you're putting all the details of the property along here, right? So your goal as an investor to buy multiple properties is to fill up this spreadsheet. You might think, gosh, I'm scared of debt, or how would I do? How would I get 10 properties? Gosh, that's too hard. Some of you might go, hey, that's too conservative. I want 20 properties. Good on you. Great, go for it. Whatever it is, just use this spreadsheet, please, to help build your wealth and get the concept of going, I'm going to need to get multiple properties, and not just property. Here we've got also other assets. Obviously you need to talk to a financial planner about diversification into shares or bonds or other types of assets as well, building up your super. But again, this is just a case study here for this. This is just a fictitious client. They've got total assets of 3.7 million, liabilities of 2.9, so they're worth 1.3. So it's a quick way to get a snapshot of just where you are at the moment and then think about where you want to go. The other tabs I've created here for property acquisition costs. So for each property you buy, it's really good to keep all of this detail, keeping what your deposit was. All these numbers are super helpful when it comes to working out your capital gains tax down the track. And then here's the numbers on a monthly basis. So you can track the rent, all the expenses, send it off to John and he'll give you a bottle of wine for saving his time, right? All right, I'm just going to click off that and go back to the presentation again. So here we go, screen number 2. All right, so we've done that. So yeah, look, please play around with that. Work out a way to re-engineer your lifestyle and move forward with it. So I want to talk about now, what are the specific strategies that you could use to buy properties? There's any number of strategies. Now, what I don't want to do today is confuse you. I want to give you a range of options, and I'm sure there'll be a bunch of questions at the end here, but let's have a look at some of the strategies. So I've categorize these into, firstly, growth strategies, and then I'll talk more about cash flow strategies. So let's look at some classic growth strategies. But first thing I'd say is, don't have hope as a strategy. I hope one day to buy a property. I hope one day to retire. That won't get you there. You need to execute. One of the best strategies I've used pretty much primarily is a really simple one, and that's buy a property and hang on to it, right? Ride out the cycles. You don't have to always go and renovate or knock down and rebuild. You don't have to do that. You can just buy in a great location and do really, really well. I've seen that happen multiple times for our clients. Some of our clients have bought 20, 30 properties over the years. It's amazing the portfolios they've created. Others are still much just buying their first one or two, but buying holds great. John, we've talked about positive and negative gearing. And again, the particular strategy of whether you need to get positive cash flow or whether you can cope with negative cash flow is going to depend on your financial situation. So let's say you're on 75 grand a year. Going for a highly negatively geared portfolio is not a good idea. However, if you're on a big income, you're on 400 grand a year, using negative gearing to your advantage is a great strategy to reduce your tax and buy high growth properties. I'm a big believer in buying established properties. Don't go for house and land packages and off the plan crap. typically that doesn't perform nearly as well as buying well-located, established properties. Regional investing can work. Again, the only caveat with that is don't buy in the far-flung mining towns or the minor regionals. I would buy in the major regionals like Newcastle, Geelong, Townsville, Mackay, Gladstone, for example, but not in sort of Longreach or Mount Isa or Port Augusta, for example. So just be really careful on your location choice. Also, rent vesting, great strategy. If you're unable to buy a property in Sydney or Melbourne and you're still renting, think about buying a property in another state. It's a great strategy, a great way to move forward. Second set of strategies I've got is what I call cash flow booster strategies. So these are things where you add extra value to the property, like doing a granny flat. You might buy a dual income property. You might do a holiday rental, co-living, NDIS, rooming houses. And particularly buying in self-managed super fund, getting a good cash flow property is quite important because you don't want to cash drain in the super fund. You don't want to keep topping it up every 2 months because you're running out of money there. And also commercial property, which has generally higher net yields. I'll talk about the risks with some of these strategies in a minute, but they're just some general strategies, and I've used a bunch of these myself. Next category of strategies I've got is renovations, flipping, subdivision, developing, and joint ventures. Again, I've done all of these to various levels of success, learned a lot of mistakes early on. What I'd say about renovations is fantastic way to do it, but make sure you put down a spreadsheet of your costs and control your costs, because we always walk into the showrooms of the kitchen places and the bathroom taps and we want to upgrade to the latest and greatest, and we want the Miele appliances, and suddenly your budget's 10%, 20% over what you estimated, right? So do be careful not to get involved in cost overruns and build in a contingency. You've got to build in a 5% overrun. So just make sure you can afford it so you're not stressed. Flipping's something that I know some people can do, but I've got to say it's not generally a preferred strategy I recommend, because you're paying a lot of extra stamp duty, you're paying extra capital gains tax. So if you are flipping regularly and you've got a whole business and you've got a team around you to do it, good on you. But generally for most passive investors, it's not a great strategy to use. And subdividing and developing, that's another whole level of risk again. I say to people, learn to walk before you run. I lost a lot of money very early on 20 years ago, and I just thought I could build properties anywhere I wanted to, but be very, very careful going into development and do it with your eyes wide open. So risky strategies. So I mentioned house and land packages. I've been talking to quite a few prospective clients and new clients just coming on who have been burnt by this. I spoke to a guy the other day who'd bought 3 properties in Melbourne, house and land packages, and they had really underperformed. So typically these blocks are located well out of town. They're in greenfield areas, which means there's a lot of land supply. They're on 250 square meters of land, which is what I call a postage stamp size block. And there's a lot of new properties also coming around it. So what happens is that those properties are just replicated a million times, or not a million times, but thousands of times. So there's no price pressure for growth in those areas. So you are typically sold them or promoted those on the basis that they'll have good tax deductions and depreciation. But that's not the primary reason to buy. The primary reason to buy a property is because it's going to deliver strong capital growth and good rental income or yield, okay? So don't be sold a pup just because of tax deductions. Same with off the plan. One note, buying with friends and family, make sure you have very strong written agreements. Don't just have a handshake agreement, even though you love each other and you live in the same house. I highly recommend getting a lawyer just to have a document prepared. It's a great way to invest if you can, if you can't afford to do it on your own, but do make sure you've just got a legal agreement if something goes pear-shaped and the relationship breaks down, because I've seen it happen before. NDIS. So I did look into NDIS extensively. I was going to do it myself, but John, I've decided not to go with it because I think it's too niche. I think NDIS generally is going to end up in a lot of problems down the track. So I don't want to end up with an asset that I can't then have alternative uses for. It's promoted on having incredibly high yields, but for me, I want a good entry exit, a simple entry exit. I don't want to only be able to sell my NDIS property to another investor. So imagine if, 10 years time, NDIS has been scrapped. The government's not doing NDIS because it's totally the cost blowout's too hard. You've got a 4-bedroom house with all specialized bathrooms. It's going to cost you 150 grand to retrofit, and no investor wants to buy it. That could be a major problem, and I don't want to have that problem. I'd much rather buy an existing house that I can sell to an owner occupier or an investor or anyone I want to down the track.
Great point, that one.
All right. So question then, obviously you'd ask, what strategy will work for you? Well, I don't know each of your names or situations personally, but have a think about how much knowledge you have, your experience, how much time you can put into things, how much income, your cash flow, and your overall goals. So it's also about your energy. Like if you're doing a renovation, it takes energy. I've renovated quite a few places. I'm pretty handy. Don't mind, building a few decks and things like that. But I got to say, I hate painting. I'm so over painting. I'm sick of it, right? So I don't want to paint another wall in my life, right? I very happily pay someone. So I'm now really good in outsourcing a lot of those tasks. But some people might want to roll your sleeves up and do the renovation backyard, the backyard blitz, whatever. So have a think about how much energy and time and passion you want to put into it. Have a think about also your risk profile, your time horizon, the effort, the objective, and particularly this last point, your entry and your exit. A lot of people think, oh, great, yeah, we'll buy a property that's got a really niche, look to it or whatever, but have a think about who will buy the property 10, 15, 20 years down the track. Who will buy it from you for a much higher price? So it should be quite difficult to buy the property you want. That's a good sign. That shows there's high demand. If it's too easy to buy the property, it could be a red flag that there's something wrong about the demand in the area. That makes sense. All right. So another question to ask you all is, what's holding you back? And I'm happy to share some personal stories here. This first one on the list for me, fear of debt. I did have a fear of debt. I was an economist in my past life 30 years ago. I would analyze things on spreadsheets, John, to the nth degree. And when people would tell me, oh, you're going to be $3 million in debt by buying these 2 properties, I freaked out. And I thought, no, I can't do it. So it took me a while to overcome that fear of debt. Now debt does not worry me. It's more around how you service that debt. Some might be worried about over leverage, the classic analysis paralysis. There's just too many options, or options anxiety. When you talked about, John, lack of a clear strategy, not having the right finance structure. So as well as having the right name, whether it's trust or company, it's also really important to have the right finance structure. So working with a smart broker that can really help you to do debt recycling and get the right lenders on board to buy multiple properties. That's super important as well, because that will potentially restrict you from buying your 2nd, 3rd, 4th, and 5th properties if you don't get that right. Another one is relying too much on emotion instead of data. Fear of making a mistake. I see some people that are just so worried about making a mistake. Look, at the end of the day, there's going to be multiple properties you can put in your portfolio. It's about getting a good one and getting it locked away. And don't make your decisions by media headlines either. I just see so many people scared about, the latest advice from property professionals that don't know what they're talking about. All right, what else have we got? So there, I just made a little wordogram about that stuff. So yeah, don't let that stuff get in your way. So another question I get asked, John, is it the right time to buy? Or when is the right time to buy? Should I buy now? Should I wait? Should I wait 6 months? Should I wait till Christmas? Wait till Easter? Honestly, I'll be a multimillionaire if I've been every dollar for that question I get asked. But buy when you have the borrowing capacity. Your borrowing capacity is the most critical thing to think about in the buying equation. I see a lot of people on great incomes just do nothing with it. Year by year goes by and they do nothing with it. So it's really important to buy when you can afford to buy. And often buying when there's a lot of negative economic news is a great strategy. I've bought multiple properties during the GFC, during COVID, when people were running the other way. That's great. I get excited because I love buying property. So I think right now is a great time. We're at the cusp of quite a strong property boom. When you're buying, you're going to need to do each of these 7 steps. I've covered these in multiple presentations before, and I won't go through each one, but these are the things that we do for our clients. If you engage us as a buyer's agent, we go through each of these 7 steps to help you There's a number of advantages. Again, I won't go into all of them to using a buyer's agent, but essentially to say you'll save a lot of time, you'll get a strategy, and you'll get the confidence to go forward. What do we charge? We work on a fixed fee, but roughly the fee, if you work it out, it's between 1.5% to 2%, depending on the price point. You pay an engagement fee of between 3,300 to 5,500 per property. But what I've got as an end of year financial special, John, everybody loves a special, don't they? Right? Yeah. We're giving a 10% discount, so either a $300 or $500 discount off our engagement fees if people sign up before the 30th of June. So if you are interested to use our service, please do reach out after this. We'll be sending around an email with a copy of all the slides and the notes, etc., to take advantage of that. And in true spreadsheet style, I compared doing the property searching on your own versus with a buyer's agent. So you can have a look at that in the slides later as well. Just to wrap up my side of things, John, before we open up for Q&A, I want to just give a couple of case studies that might highlight a couple of key points. So I hope people are writing their Q&A. Yes, I can see some people have put some questions in the Q&A box. That's great. What's the first one here? So first one here, this is actually one of my properties. I bought this property on the Northern Beaches. It was just a classic 3-bedroom post-war home with a granny flat behind the garage. It was already there. Now, when I bought it, it was pretty run down. We did a reno. We spent about 100 grand on fixing up the kitchen, the bathrooms, and the granny flat. Now, when I bought it, it was renting for $750 a week. I paid $850. It now rents for over $2,000 a week, and it's now worth 3.1 million bucks. So, John, what do you think of that kind of return? Happy with that?
I'm very happy with that. Three grand. So $2,000 is already 100 grand a year, right? So
yeah, correct. That's
good
right.
start.
Yeah. And the other kicker for me, it's also in the new LMR rezoning area. So I could be able to develop this very soon as well. So it's been a great performer for us. Never had much of a vacancy, always in high demand. So it's been a really good one. So a couple of examples. Mentioned we're buying properties in some of the major regionals. This is one we bought in Townsville last year. We paid $431 for it. That same property today will be worth about $530,000. So that investor, I can't remember their name, but they've made 100 grand in just over 12 months by buying in the right area. So I guess a point of comparison is try to save 100 grand, John. How long does that take most people? It takes years and years, right?
Yeah, too long.
One property, bingo, you're there. Okay. Another similar one we bought in June last year as well for around the same price, and that was getting at the time a 6% yield. The yields have come back a little bit in that market. Very hard to buy on-market properties in Townsville. Pretty much everything we get up there is off-market at the moment. All right, another one we just bought recently in Brisbane. Again, about 20 k's out of town. We got this for 727,800. You love that negotiation, right? Unless an odd number. It's getting a 4.25% yield, but a really, really nice quality property. Really, really, really good solid property, which I think will double in value in the next 10 years. Here's one we bought in Melbourne, in the northern parts of Melbourne. 4.5% yield, $500 a week on a $575 purchase price. Good quality home on a decent block of land. One we just bought in Perth, just getting over 5% rental yield. Bought this the end of last year. Got that for $545 on a $535 per week return. I'll just jump through a couple. I've got a whole bunch of slides here. We've got a heap under 700. I'm going to go to some of the over 700K purchases. This is one we just bought in an area called Springfield Lakes, which is a really nice area of Brisbane. 820,000, rents for $725 a week. Now, this area is a beautiful master planned area. Very high percentage of owner occupiers in this area. So, yeah, we think that market is very, very strong and performed really well for our clients. Another one we bought also on the Gold Coast just recently, paid 840,000 for it, 800 a week, almost a 5% yield. Just a classic set and forget type investment. Really, really good one. Another one we just bought a couple of months ago on the Central Coast, but up there near toward Wyong. This is a nice one. It's had a pretty decent rental yield for the area. Managed to get this for $895, negotiated pretty decent reduction in the price on that one. But again, great low maintenance type property. Very affordable, we think that'll perform really, really well. I'll just go a couple more. It's another one we did recently, Central Coast. There was another one I want to show you, John. Where is it? Not quite here. Yeah, this is a really good one. We got this one below bank val. Very unusual to buy a property where we get the valuation higher than what the bank says. So this was an absolute steal. We appraised it at $1 million. We got it for 975, and it's delivering 950 a week rent. So really, really good. So the client was super happy. Because we are able to act really fast and we know how to deal with the agents, we know how to deal with solicitors. That's the reason we get deals done. So look, I'm going to open up to Q&A. I'm just conscious of time, John. There's a bunch more slides I can share in there, but all the details to get in touch with us are there, and then I'll close it up for Q&A. Just to stop the share. So, John, any questions you've got or comments on my presentation just to start with?
Oh, it makes sense. It's the research, isn't it, Rich? So you've done all the research, you found the areas, you're buying under market, you're not buying anything overpriced, which is exactly what the research that people have to do, or people haven't got the time to do, and use your services.
Yeah, great. So here we go. Let's jump into questions. We've got 20 questions so far. When is the best tax file time? Mid-year or following year before 15th of May?
I suppose that one's for me, Rich.
That's for you, mate. Yeah.
Look, it doesn't make a difference when it comes to tax, right? Because you're still going to pay the same amount, no matter when you lodge it, or you're going to get the refund the same amount. We just say to clients, if you're going to get a refund, do it early. If you're going to be payable, we can still do it for you in the early part, July, August, September, but we don't have to lodge it until later on. So the payable amount becomes a bit later. So you keep more money in your pocket, but at least you know what that amount is. But get it in early, because if you've got a large amount, you want to plan for it of how to go ahead and pay the taxes.
Yeah, great. Someone's asking, is it worth getting a second opinion? I suppose they mean a second tax opinion, John. Is that right? If let's say they've got an accountant, is it worth asking you a second opinion?
Look, always is. If you're not getting confident answers from your accountant, then maybe get a second opinion. The accountant should be saying, yeah, in that situation, we can do this. In that situation, we can do that. That's the best way. That's the rule. We've had a lot of clients come on board recently whose accountants were a little bit, it should be okay. And if you get some not confidence, then yeah, definitely get a second opinion for tax. Yeah.
Okay. What strategy should an investor use to mitigate against future risk of elements like the prospect of unrealized capital gains tax?
I knew I was going to get this question. Look, just want to put it out there for everyone out there that the current government has introduced this new law. It is not legislation yet. We do not know what it's going to look like. They're talking about superannuation only. That anyone who's got more than $3 million, and that is $3 million per person. Look, I've got nothing against taxing someone who's got $3 million of assets inside super, or a couple who's got $6 million inside their super fund, a little bit more, right? And it's a little bit more on the income. I do have an issue with the fact that it's not taxed, or sorry, not indexed, sorry, and it's on the unrealized portion of it. I think that's totally against what we stand for in Australia. How can we pay tax on something we haven't sold yet, or it's a little bit unfair. Look, It doesn't come into legislation. With the question, we don't know what's going to happen with other elements. Governments can change laws all the time. We just have to mitigate around these things. We're already working out some strategies of how to go ahead and do some stuff for clients that are in super and not on that level as well. So it's a case-by-case scenario.
Yeah, I guess I'm sort of looking at those same questions myself, John, and I think it hasn't been legislated. I think unrealized capital gains tax is just absolutely wrong. And I also think non-indexing is completely wrong. But wait till that comes in. But I'd still highly recommend buying properties and assets in self-managed super fund.
Yeah, me too.
Can trusts have depreciation benefits like an individual? Yes, they can, right? Absolutely.
Yes, they can. Look, one thing people should know about trusts, though, trusts are really flexible, really good, but really bad for negative gearing. You cannot, if you buy a property in a trust and it's got negative gearing, you can't use that in your individual name. Okay, so we have to look at those kind of things when we make a decision on what structure we buy in.
Yeah, great. In regard to the self-managed super fund, how much do I need in super to start this? In other words, what do you think, John? Do you think there's a certain number they need to get to before they start thinking about buying a property?
Yeah, I get asked this question a lot. So there was a guidance about 4 or 5 years ago from ASIC, which has since been retracted because they said it was too broad. But what they were talking about were fees. And they said that you need a balance of $200,000. Anything lower than that, we do not recommend self-managed super funds for you, right? But then that got retracted because they said it was too broad. We can't really tell you that kind of information. But on the basis, $200,000 is the basis where the fees inside the self-managed super fund, which is a flat rate, equals probably the progressive rate under a public or an industry fund as such. I'll tell you a stat which is really important for me. It's that there's only 6% of people in Australia who have a self-managed super fund, okay, which controls 40% of all money in super. It's where the smart money is. So as soon as you've got more than that 200 or 250, then people are moving to a self-managed super fund to save fees and also to do these other things such as buy property.
Yeah. I think it's a very smart move to set one up. Highly recommend it. Thoughts on buying in the Ballarat region? So from someone anonymous. Yeah, look, Ballarat's a great regional town. I mean, again, it's like Bendigo, sort of similar kind of area, really strong. Again, it's just going to depend as to rather than asking where to buy, it's more looking at your portfolio and go, where haven't you bought? Where is going to be the best location to put your money for the best return, both capital growth and yield. So I think there's areas that could deliver slightly higher returns than Ballarat at the moment. As I mentioned, I think some of the northern Queensland areas and circa Brisbane certainly can deliver the higher yield and growth in the more immediate term. How much buffer should you have? I guess this is probably a two-pronged question, John. Let's answer this in terms of how much buffer should you have generally versus buffer in your self-managed super fund.
Yeah. Look, personally, I don't. Look, everyone's got a magic number in their head, which I say to clients, what's the number that you see on your net bank that makes you sleep better at night?
Yeah.
And everyone's got a different number they sort of have. So it's, once again, if you do your numbers early and you work out what you need every single year to contribute, then you probably have a fair bit of a buffer there to go ahead and contribute that. Look, properties, the biggest risk of property is a tenant moving out. Not the biggest risk, but one of the risks is tenant moving out. But if you look at, like if you do the research that Rich, you do, and look at the tenancy rates of certain areas and notice that, there's only a 1% vacancy rate in the area, for example, then that's going to get rented pretty quickly. So once again, horses for courses when it comes to buffer. It's whatever makes you feel right, but also at the same time, you do numbers and you can base on that.
Yeah, I think for me, it's like having 3 to 6 months worth of income. If I was suddenly injured, it's also about having income protection insurance, life insurance. Like there's other things that you can reduce your buffer if you've got other safety nets available. Bill mentioned, what about fear of the tenant? Yeah, great one. I mean, I could only limit it to 10 things on my slide there, but fear of tenants is a great thing to talk about. One way to mitigate fear of bad tenants is to have landlord insurance, which you must have. I use Terry Shear myself for all my properties. I've had to make a couple of claims and they've been great. So you've just got to make sure you also pick the right property manager who will vet the tenant and make sure they get the right person in there in the first place. So getting the property manager that is going to be really strict with the kind of tenant is also really important. Nandish is asking, after buying a property in a personal name, is it better to set up a trust and buy a property in a trust for the second one? Does it help more in borrowing power having a trust? What are your thoughts, John, on that question?
The first part, tax part on that one. So once again, the answer depends. Is the property in a different state? Is it negatively geared? Is it positively geared? We can all have a look at that. And then based on all those, a trust could become good, but sometimes it's probably not worth to have it in a trust. Land tax is one of those things that's going to hurt you in trusts that you can avoid under your individual name potentially. But once again, it is a case-by-case scenario. It depends on the property, depends on the income levels.
Okay. Awesome. Rachel's asking, I have two houses, looking to pull equity to buy more. What's your personal opinion on investing in apartments in capital cities like Melbourne? And top 3 things you'd advise clients to look out for in due diligence. Look, I think capital apartments, I was actually talking about this before on a podcast just before I did this today. And apartments are going to become more popular, and I think will have stronger capital growth than they've had in the last 10 years. So when I've crunched the numbers, John, I looked at Sydney, Melbourne, and Brisbane for houses, which typically had a capital growth rate of 7.5 to 8%. Now, for apartments, the growth rate was around 5 to 5.5%. So apartments have been about 2% lower in overall capital growth. However, going forward from 2025 to 2035, I think apartment living will become even more prevalent. I think existing apartments will, like not brand new, but existing apartments will rise at a faster rate than they have been for a couple of reasons. One is population growth. Secondly, because construction costs and the replacement cost of those apartments has gone up so much. We've bought quite a number. If you look through some of those examples that I'll be sending out to everyone, we've bought quite a number of apartments in Melbourne for our clients where the land value is like 80 to 90% of the purchase price. It's incredible. So you can get some apartments even below replacement cost now, and they're delivering great yields. So yeah, absolutely, 100% endorse that idea of buying apartments in Melbourne. Things to look out for, obviously, strata report, make sure there's no special levies, make sure there's no sort of water penetration and concrete cancer, make sure they're located close to shops, schools, transport, all the connections, and make sure they've got good natural light, good floor plan, a good layout. That's the other thing I'd be looking for. Phil Worrell, it's more a comment. I don't really understand that question.
I
Damien's
think there's a
asking,
second part of it, a few comments down. If I sell now, can I
oh,
claim all the acquisition and keep costs against CGT? Yeah. So there is actually a special rule there for cost base. There's 5 elements of a cost base when it comes to tax. The first one is buying the property itself. Second is the stamp duty and legal fees of acquisition. The third, fourth, and fifth talk about retaining the property as well. One of them is actually if you do not if your normal expense on the property, like for example, council rates, water rates, for example, that you normally would claim, that you haven't claimed because it's not earning income, you can add that to the cost base when we sell it. So yes, you can, including land tax as well. So keep all your record. It's funny one. I've got a lot of clients with the holiday houses, and I tell them you've got to keep your records for the next 20 years. All your council rates, your lawn mowing expenses, and all that stuff. But it's a good question actually because I don't get asked that too often. I have to tell clients.
good question. Damien's asking, do you set an target annual rate of return or IRR in your strategy? Do you ever deviate from that rate? I'll answer this one as well as you contribute to, John, but my general target for properties, minimum 7% capital growth rate and around a 5, I'd like to get a 5% yield. So that's a total return of 12% if I can.
Yeah.
Now, obviously, I'm in the game, so I'll use a few other more smarter strategies to get higher than that. So that's what I aim for. John, what about yourself? Mm,
I think that depends on the city though, right? Sometimes in Sydney, for example, you're paying a little bit more,
mm,
or sometimes you pay a little bit more for the property or the land, for example, that you may not be able to get the 5%.
mm.
So it depends on what your target is. Once again, we talked about strategy. Some people, you're going to get probably higher yields in units than you are in land as such, but then some people want land. So, give and take. There's a price there for a reason.
So I do, to answer the last part of the question, yes, I do deviate to your point about location. So if you're buying something in, say, Sydney or Melbourne, which is going to have a lower yield, but you're going to get exceptionally growth rate above at 7, then that absolutely you can deviate from that. I think we've answered the question of how much super you need.
Yep.
What is the property position? When are you going to be retiring? How much debt will be remaining on those 5 properties? Yeah, I guess again, that's just a matter of playing around with the spreadsheet. It's going to depend on your age and stage as to, you just again, it's about there's no hard and fast rule as to when you retire and how much income you're going to get, but you want to be in a more comfortable debt position if you're thinking about slowing down from work. The other point to make, John, is that if you're looking to buy more properties, you've got to be earning an income generally, right? You've got to be able to show
Yep.
serviceability. So that's why it's really important to plan out as early as possible your ability to buy those properties.
Yeah. And have a plan at the end as well, because we've got some clients, for example, who bought 20, 30, 40 properties over a long period of time, knowing they're going to sell, they're going to keep going up in price. And hopefully by the end of it, when they stop working,
Mm.
then they'll sell 2 or 3 or 4 or 5 or 10 or whatever it actually takes them to knock off the rest of the debt of the other ones,
Yeah,
right? And they're left
exactly.
with the remainder. So there's a ongoing plan, there's a strategy, but there's also an end game as well.
Yeah. Someone's made a funny comment. If 7 properties, reckon we'll need to retire to self-administer. I'm not a bigger believer in self-managing any property. I managed one of my very first properties and quickly learned that dealing with tenants is not a skill set that I want to develop. So, and there's so much legislation now around rental properties that it's far better to pay the property manager to look after it. So that's what I'd recommend. Land tax on unrealized capital gain and its LF. I think we've answered that one, haven't we? Is that right?
Sort of. Yeah, look, I agree with Phil's comment. Land tax is tax on unrealized capital gains. Yes, in a way, I look at land tax as being like a council rate in a way.
Hmm.
That's probably not a great way of looking at it. I don't like land tax. I'm a big believer in trying to get rid of land tax as much as you can. I've got one client who pays like 100 grand worth of land tax a year. He's only got a few properties. He's just done the wrong way before my time. But
Hmm.
other clients who have got a dozen or so don't pay any land tax. So there are ways of getting around it. You just got to make the decision at the very beginning rather than during the process.
Yeah, great. Cool. Someone's asking, do you set up self-managed super fund or just tax advice? Hmm.
Yep, we set up self-managed super funds. We set up other trusts and other structures as well. Yep.
Great. Can equity from other property offload to self-managed super fund?
No,
Hmm. Okay.
no. So let me rephrase it a little bit. So there's two types of borrowing in a self-managed super fund. One is a direct bank borrowing, and the
Hmm.
other one's called a related party borrowing. Related party borrowings come off a little bit now, but it's still an option there because what it means is I'll go to the bank against my main residence or another property that I have and say, can I get an equity release of that? Let's call it $500,000. And then I'll lend that to the self-managed super fund and I'll run it like a normal loan with the bank.
Hmm.
Okay, so that's okay. You can go ahead and do that. And then your self-managed super fund can buy a property. So that's probably one way of looking. I'm not sure if that was the question that was being asked though.
Yeah, I mean, when you've got a property in self-managed super fund, you can't leverage off that equity to then go and buy another one within your self-managed super fund. However, if you had equity outside of the self-managed super fund, you can harvest that to then either put into your super or use that to buy a property through, or add that to your super and buy a property there. Reema's asking, what do you think of Seaford in Melbourne? Yeah, great area. Near Frankston, fantastic area, family friendly, right on the Bayside area. Just a note, that area has really gone up dramatically and has continued to rise. It's probably gone up about 100 grand already this year. So, yeah, pretty nice area. Is it possible not paying stamp duty? Not unless you're a first home buyer, Lynn. So, it's
Well,
one of
just
those. Yeah.
just on that, once again, let's be a bit smart with this. So yeah, first home buyers, no stamp duty, completely agree. But there's other ways of, I'm going to talk about transferring. So we had a situation recently where a special rule out there that we had a client who went through a divorce, so it's separation. So, the deal was that they would take the properties and the partner would take a different kind of asset, for example. But that property was under one partner's name, they want to be transferred to another partner. So there is special rules out there that if you transfer it due to separations, there's no stamp duty on the actual transfer. The other thing we also note is that sometimes we have older parents, for example, who want to sort of help the kids out a little bit, and they say, "Oh, what I want to do is I'm going to transfer my property up to the kid's name, for example, like give them the inheritance early." But if you transfer it, actually costs stamp duty. But if you pass away and leave it to them in their will, there's no stamp duty. So we've got to be a little bit smart with these things, and there's definitely ways of avoiding stamp duty in
Yeah,
some
great.
circumstances. Thank you for that question.
Ah, fantastic. Can you assist with complex strategies like splitting borrowing capacity for children, first property? Yeah, I guess that's a question that, yes, I mean, John, you can answer that, but I think working in combination with a good mortgage broker, I think that's something that can definitely be done. So I think the answer is yes to that.
Yep.
Teleportation doesn't exist. Do you work with local buyers agents when you're buying in regional areas? Yes. I've got 32 buyers agents around the country, so we are nationwide. View on mixed use property of resi and commercial. Yeah, great. I mean, I think just the question I'd say about commercial is don't jump into it with your eyes closed. Some people think, oh, I'm really attracted to commercial because of the yield. Well, commercial property is great, but often I'd say get a couple of resi properties behind you first because they often will grow at typically a faster rate than commercial and then leverage into commercial later once you've got a bunch of equity behind you is my general advice. Hmm.
Just with that one as well, Rich, I'm not sure what you think about this, but I've had a lot of clients who are in business and they want to buy the office they're in, for example.
Hmm.
My take on this is, look, it's a great idea. I love it. You put your money to use, and they can also use the self-managed super fund to buy it as well. My take on business is that business changes a lot. We've seen that over the last probably 5 or 10 years a lot. Like I've had to change my office probably 4 times in the last 12 years because of growth, right? And so if I bought, I would have got stuck with a property that I didn't need anymore. So when you're buying property for your own business, I think it's really important to always have a backup plan, which is part of the strategy. All
Mm.
right. So I'm going to use it for the next 5 years, but if I do leave and go somewhere else or close a business down, whatever it may be, then what's my plan going forward? Like, who else
Mm.
can I use it by? You mentioned about the NDIS properties. You don't want to do your commercial property so specific that it's not attractive for any other tenant, for example.
Mm. Yeah,
So
cool.
something to definitely consider as part of the strategy.
Okay. We're just about out of time. I know there's more questions coming, John, but maybe two more if I can just handpick the questions. I kind of answered the long-term growth question already. Um, how do you filter out property managers? Hard to find. Yeah. Like part of our service is recommending a property manager. So depending on where it is, we could recommend one to Bill. I have 50K positive cash flow from a trust. Can I make my son a director of this trust when he turns 18 and loan him the deposit to get into the property ladder earlier? What do you think of that one?
There's always strategies to do it, but if you're going to give your child a property, maybe it's better to put under their name rather than a trust because they're going to be smashed with capital gains. They probably use the main residence exemption.
Mm, mm,
So there's a few things there that you can do. But if you've got scenarios, this is a great question to ask your accountant, right? Your accountant knows your situation. They can go through it all and work out what's best for you. And sometimes the best thing is to do nothing because it's going to cost you a lot of money to do so. There is a special rule, though. If you change the director of a trust, sometimes it's called a resettlement of a trust, and you have to pay stamp duty again because assets have technically been transferred across. So you've got to look at that one as well.
okay. Look, I think we're out of time, unfortunately, John. I know there's a bunch more questions, but look, can I just say to everybody, thank you so much for all of your attendance today. Really engaging. I love the questions. They're coming thick and fast at the end. But do reach out to myself and John. We'll be sending around a copy of the slides in PDF and also access to the recording for those that want to watch it again or bits or those that missed it. But please reach out, stay safe, have a great weekend, and thank you, John, for participating today.
Thank you, Rich, for having me on board. Appreciate it.
Thank you, everyone. Have a great day.
Cheers.
Bye.